Good morning, everybody. It's Friday, August the 7th. Here's what's on the agenda. Oil's higher once again on reports of an Iranian strike in the Strait of Hormuz and no progress on talks. We wait for the US jobs report as some Fed voices call for action to restrain inflation. And we get positive AI vibes as Alphabet issues more debt and it's well subscribed. And we're through the first SpaceX lockup expiry. Lizzy.
Well, that flare-up in tensions in the Middle East, Anna, and the lack of progress on a deal has driven Brent there to $83 a barrel, up 1.4% this morning. That powering yields higher yesterday in the session, up about 6-7 basis points across the curve. 468 is where we hold right now. And that weighing on sentiment as we head into the European cash session, down 0.2% on Euro Stoxx 50 futures. The countdown to the opening trade starts right now.
Good morning, everybody. Just gone 7 o'clock then here in London. And we are once again talking about a higher oil price, up by 1.4%, as Lizzy, you've just been pointing out. 83 is the handle once again on the Brent price. And this has been a story of the past 24 hours. We saw the oil price rise yesterday. We're seeing the oil price rise once again. And the most proximate factors for this, a couple of them coming out of Iran. So reports that Iran has attacked what it calls hostile targets, a lack of detail on what that means in the Strait of Hormuz. And also Iranian local media in Iran suggesting that Iran wants to bar US and Israeli vessels or ships from going through the Strait of Hormuz. They say that this is part of the agreement with Oman. How do we put that up against the accounts from the US president that talks are going well, moving along good, was the line coming from the US president? The bottom line to all of this seems to be that the MOU fell apart. And it's unclear how we get that back on track. It's still unclear, despite accounts from both sides that there are talks. What exactly is being agreed at any one point is difficult to ascertain.
Yeah, and clearly it's not going to go down well in Washington if you have the US and Israel barred from using the Strait, although there aren't that many of those ships that go through with those precise flags.
Yeah.
But also Iran saying, according to, as you say, local media, that there's going to be compensation required for hostile countries going through the Strait of Hormuz. Now, yes, you've had these positive signals from Donald Trump on the talks, but we haven't heard much from the Iranian leadership, the new supreme leader, and J.D. Vance talking about how this has been an issue to get a deal over the line. Iranian officials saying that communicating with him takes a bit of time. So then you have to go, as you say, back to the original deal between the US and Iran, and Washington hasn't indicated whether it would still be waiving oil sanctions on Iran or unfreezing frozen financial assets. So you could say that we're as far from a deal as we ever were when it comes to reopening global trade. And then you've got the widening of the conflict as well. So the semi-official Iranian Fars News Agency saying that Iran's naval forces had struck hostile targets at the entrance to the Strait. Iran-backed Houthis saying that they've attacked forces from Yemen's Saudi-aligned government. And so all of that put together, you can see it on the screen, oil volatility staying high.
And it's difficult to really work out what is the role of the US in this, because Iran talks about the talks that are taking place with the Omanis. What is the US input into that conversation? Because the Iranians are saying that what has been agreed is that Iran will control passage into the Strait of Hormuz and that Iran and Oman will jointly control traffic leaving the Strait of Hormuz. I mean, none of this sounds like things that the US would want to sign up to, because they wanted full freedom of navigation, just as we saw before this conflict began. So it's difficult to see that we're making huge progress, which is exactly why we are seeing not just oil prices, but other energy prices higher this morning.
Yeah, and yields higher yesterday in the session as well, which brings us to the payrolls print, because this is the backdrop to the number that's coming out later on today. We want to know whether the June soft print was a blip or whether it's the start of a trend. We want to know whether the June number actually gets revised. But if you look at the expectations, so 57k was the June reading. Consensus for July is 80k. Last I checked, the whisper number was 79k. And this data taking on increased significance because of the lack of Fed communications, because of the lack of forward guidance from Kevin Walsh.
Yeah, absolutely. And it's interesting to think about some of the one-offs. I mean, we're still dealing with a bit of the World Cup effect in these numbers. That certainly ended the middle of this month that we're talking about here. So that's going to be something worth considering. The unemployment rate, I'm reminded by Bloomberg Economics, could actually tick up even if we don't actually see more joblessness. And that's interesting. This is to do with the change in participation rate of prime age workers. So that's something to keep in mind as well. But you're right to point to what we're hearing from Fed officials, because we've heard from Alberto Muslim talking about how we can't tolerate an increase in inflation while we wait for an increase in productivity. And I think that's interesting because it goes to the sort of longer lens that Walsh wants to attach to this, which is, yes, AI might be inflationary in the short term, but longer term he sees it as disinflationary. And maybe this is Muslim trying to get in ahead of those who might argue we need to perhaps look through a spike in inflation attached to AI because it will eventually be disinflationary, which does seem to be what a lot of guests are saying to us in terms of the inflation dynamic.
And indeed, we've had hawkish Fed speak from the likes of Neil Kashkari already earlier this week. We've also had lots of jobs data, as we always do, running up to this print. So just to remind ourselves, on Tuesday you had job openings edging down, but hiring picking up slightly, layoffs staying limited. Wednesday we had private payrolls surprising to the downside. Yesterday, jobless claims well below estimates. And overall, firms just not actively cutting, even if they're slowing hiring. So this labour market isn't cracking, but this is going to be a really important read for the September decision.
It is going to be important, and it's really fascinating to see how the AI build-out and the AI excitement and trend is working its way through the US economy. And what do we see about that in the jobs report? So let's go on to talk about tech themes, because I mentioned in the headlines we've had a couple of slightly more positive dynamics, I suppose, around AI coming through, certainly from the US. So Alphabet selling $25 billion of investment-grade bonds. And the strength in this story comes from the demand. They could have sold around 4 times this, it would seem, in terms of the demand level that was there. I mean, they did have to compensate with a slightly higher yield spread over Treasuries, I think 1.3 percentage points over Treasuries as the yield, because there are still lingering from July those concerns around too much capex in AI and what that means. So that's one story. The SpaceX story, also, it's possible to see a positive in there. The fact that we saw some volatility in the shares as that first of, 9 lockups expired around SpaceX shares. We saw volatility, but in the end, at the end of the day, those shares settled up 6%. So does that tell us something positive about the willingness of those who own these shares, whether they're staff who own them a long time or new entrants who maybe are underwater on the IPO price? They're willing to hold on to them at this point.
Yeah, but for all that roller coaster ride that the stock's been on since the IPO, if you were an earlier investor, you could have a paper gain right now. You could be holding on to it, as you say, but the bottom line, there's still plenty of demand. And this is both, stepping back on the credit side, as you see from Alphabet, on the equity side, as you're seeing from SpaceX. So it's a positive note to end the week for tech.
Yes, and another tech story that we're keeping across is the OpenAI story. I heard you mentioning this in Daybreak as well. Yes, a new device that is a kind of a smart speaker, isn't it? This is OpenAI's soon-to-be launched device. We haven't seen it or heard much detail about it before, but we've got this Bloomberg scoop that says it's, donut-like. It's going to have a, quote, unique look with moving parts that give it personality, makes it feel more alive. I have no idea what that means, especially when you're talking about a device that's only the size of a hockey puck, which is about, for those uninitiated, is less than 10 centimetres in diameter. So how do you put moving parts and all of that personality in something so small? I have no idea.
I have no idea.
I'm sure Johnny Ive knows, though, and he's been working on it.
Well, we've been visualising it in the absence of a picture of it, but this is on the path to replacing smartphones, and you can talk to them, apparently. It is going to learn more and more how to interact with you in a human-like fashion, so we cannot wait to see what this is going to look like. Well, coming up on the programme, Japan confirms that it intervened in the currency market 3 times during the spring Golden Week holiday to prop up the yen, so we'll get you details on that. But also, the CEO of defence giant Rheinmetall has been telling Bloomberg that he's unhappy after losing a German naval contract worth several $1 billion. We'll bring you some of that exclusive conversation with Armin Papaga later on in the programme. Up next, though, Nanette Heckler-Feiderb, EMEA CIO at Lombard Odier, to discuss the markets. And if you've got any questions of your own for our guests, please do share them with us. You can use the function IB plus BBTV Go on your terminal. A good morning from London. This is Bloomberg.
I don't want to say it has been. It's sort of open right now. You know, we have a thing called the blockade headed up by the U.S. Navy, and we control it. And now we control it, but they can always shoot something. They always have something or drop a mine. I think we're doing very well. I'm involved in the negotiation. I think we're doing fine. It could be soon.
President Trump speaking to reporters from the White House there, and his comments followed by reports of an Iranian strike in the Strait of Hormuz. Iran reportedly also says that it wants to bar US and Israeli ships from the strait and require payment from hostile countries to sail through it. European natural gas futures jumped and oil's higher as traders await the US response. Let's get more now from Bloomberg's Abir Abu Omar out of Dubai. Abir, it's difficult to make sense of all of this morning. We've got conflicting comments from Washington and Tehran. What seems to be progressing in Tehran seems like nothing that the US could agree to. How far away are we from resolving the situation?
A really good question, Lizzy. The short answer is we just don't know at this point. But look, a few important caveats to bear in mind here. One is that those reports that have come about in your intro about Iran saying that it will bar Israeli and U.S. ships and also toll countries whose ships are going through that it considers hostile, those are according to Iranian media reports. We still don't have the final draft of that agreement between Oman and Iran. And then the other important thing is that historically, the number of U.S. and Israeli ships that would go through the Strait of Hormuz is very minimal, if not nil, actually. So this could be seen as a symbolic step by Iran. But perhaps what is more important in those reports by Iranian media is the fact that Iran is considering tolling or charging hostile countries. A lot of traders are betting that those could be seen, or those are interpreted as Middle Eastern oil exporter, those in the GCC. So that could be a dangerous rhetoric going forward. But what we know from the Iranian media, again, is that this draft is in the middle, or is on its way to the parliament for it to agree on it. We don't have a lot of clarity yet on the wider situation or on whether this is actually what is going to be in the draft. But perhaps what is also more dangerous, Lizzy, and again, you've mentioned this, is that in the midst of all of this happening, in the midst of these supposed negotiations, we're seeing Iran still seeing ships in the Strait of Hormuz, as a matter of fact, getting attacked. So earlier in the morning, we heard reports again from Iranian media about it hitting 2 ships in the Strait of Hormuz that it called hostile. Yet again, we don't have a lot of clarity on what exactly those ships were carrying, but you're seeing Brent crude prices reacting to that news. So we're seeing the danger in the Strait of Hormuz still very much persistent. We await more clarity on what exactly is in the draft, and we're also watching the parallel aggression happening between the Yemen-based Houthis and Saudi Arabia. That is also escalating. We heard casualties in Yemen between the Yemen-based Houthis and the government there that is backed by the Saudi coalition. That is the biggest escalation since 2022, when a truce was reached between those two parties. And so you're talking about a widening parameter of the war in the region. So quite a dangerous situation, not a lot of positivity. But of course, we await the American response and whether it will agree to this draft. Very unlikely at the time being.
Abir, thank you very much. Bloomberg's Abir Abu Omar with an important reminder about waiting for the text of of whatever is being discussed, rather than just relying on the media rhetoric, which is often what we have in the meantime. Let's think about what higher oil prices, persistently high oil prices, mean for global asset allocation, and talk to Nanette Heshlefeh-Derb, EMEA CIO over at Lombard Odier. Nanette, nice to speak to you this morning. So, can we think about the role that oil prices at $83 or around $80 play in your asset allocation, Nanette? Does that mean you're concerned about higher bond yields, you're concerned about European stocks, leaning into commodities perhaps? How evident is a higher for longer oil price in your asset allocation?
You know, this oil price developments have really been more a question of volatility and how much inflation risk premium is coming through yield curves. So we have seen the term premium in the US yield curve steepen, which means, and it's certainly a little bit of this reflection that there is more uncertainty around inflation prints that depend a lot on what is happening on a week-by-week or month-by-month basis on oil prices. And this has meant in turn that we have had on fixed income, perhaps a bit of disappointments there. Fixed income is on the one hand really attractive by the yield levels and the income it generates, but then if you are having this volatility in the long end of yield curves, it can also be really dangerous to have too much duration. So I feel that there has been more caution with respect to fixed income as a result of this volatility.
There are positives for Europe in this, though, aren't there, in terms of equity markets and earnings? I'm thinking about the London market here, Nanette, because you point out S&P earnings are up, 48% in the second quarter on some of your analysis on the S&P. And then you point to an underwhelming performance in Europe broadly, which is up around 13%. But the UK, in between those two numbers, up by 35%. So that just goes to underscore the earnings benefits, at least, that the FTSE 100 can derive from a higher oil price. Are you leaning into the UK at this time?
Well, we have to say we haven't really benefited from it because we have been underweight the UK equity market, and it's not worked for us. The UK has, from a sector composition, this exposure to the energy market and has been the beneficiary of every boot of oil price going up. And so this has been the story of the earnings surprises, the positive earnings surprises for the UK market together with financials. But then again, we have seen how quickly oil prices can drop once the situation about the Hormuz Strait and the shipping through Hormuz gets really clarified. So it has been for us a matter of waiting and going through this period of unexpected strength. And then on the other side, Europe has generally not the same sector composition. If you think about continental European indices, for them it would be really the opposite story. Oil prices coming down would be a boost for them and their earnings outlook.
Well, what else is stopping you leading into the UK then, Nanette? Good morning, it's Lizzy here. Because on the flip side, when you talk about Europe, we've heard scepticism on this programme about the outlook for European stocks, partly because of the Chinese competition for autos, partly because you've got France and Germany shedding jobs, partly because the boost we've seen to banks is maybe tied to the short-term situation of having higher interest rates. What do you make of that?
I think for Europe, we've been really happy to stay neutral with respect to the exposure to European stocks. But what is speaking for Europe is that generally global growth has really surprised to the upside. Take a look at what manufacturing has done over the past quarter or so. It has been across the board, across many regions. It has been pushing up here. And for European indices, industrial recovery is good news. So that if you couple that a global economic growth strength story with the prospect that eventually in a midterm election year, there is not a lot of likelihood for persistent geopolitical escalation. So eventually oil prices should be coming down. That should help as well European indices. So I'm leaning against too much negativity here with respect to European equities.
Well, you are overweight EM, but I look at Korea and see, how much TSMC, SK Hynix, Samsung dominate. They're 70%, I think, of EM IT. Is that really a diversifying trade away from AI leadership? We've seen such volatility on the Kospi. Is it not just as risky as betting on the Mag 7 until the bubble bursts? Why would you be so positive when it comes to EM?
Yeah, emerging markets has indeed really been driven by what the South Korean market has done. So absolutely, this has been an important driver. But then again, when you think about the heavyweights in terms of emerging market equities, there is China there that is interesting for us, that has more catch-up potential. And then what is interesting about Chinese equities is that at a time when U.S. real yields are moving up, as they did over the last 6 months there, Chinese equities tend to be much more resilient. So we're really looking for a broadening out of the emerging market equity rally, and we are still confident that the earnings that we are getting through altogether are speaking for emerging market equities still.
Nanette, thank you very much. Thanks for your time. Good to speak to you. Nanette Heschler-Fader, Lombard Odier's EMEA CIO.
Well, here's what else you need to know this morning. Apollo has agreed to buy EasyJet for £5.7 billion, clinching a deal that's likely to shake up the dynamics in Europe's highly competitive market for budget airlines. Earlier, rival bidder Castlelake said that it was not raising its most recent offer, ending the bidding war. EasyJet shares closed on Thursday about 7% under Apollo's offer price. They've consistently traded below the escalating bids, suggesting that investors may be doubting that any deal could overcome regulatory hurdles. Elsewhere, the UK government has declined to rule out increasing taxes on banks in its upcoming budget. Strong profits have fueled calls from some for a bigger levy on lenders, but executives have warned that an increase in the levy could deter investment. The Treasury says tax decisions are for the Chancellor to set out at fiscal events. And Japan has confirmed that it did intervene in the currency market 3 times during the Spring Golden Week holiday to prop up the yen. Official data shows Tokyo bought nearly $40 billion of yen across 3 days on April 30th, May 4th and May 6th. It marks the largest ever monthly foray into the market to support the currency. Well, on that story, Anna, really interesting to see this FT report that European officials are complaining because it seems like the US did all of this by selling euros to buy the yen, not dollars.
Yeah, absolutely. And so from that, a lot of people are taking interpreting that as the US doesn't want to see a devaluation of the US dollar, doesn't want to see higher yields because of selling of treasuries, and so better for them to sell the euro instead. I don't know if I'm surprised that the Europeans were not involved in this decision-making by the US Treasury. We heard from Scott Bessent earlier this week, didn't we? He said that we are in close contact with the Europeans. He'd assured the Europeans that it was just a reserve reallocation and that the euro seemed much closer to its equilibrium price. I guess he meant there versus the yen. So interesting to see him talk. Well, I mean, putting all his experience in hedge funds and in markets to use, at least, in this particular episode.
I'm not sure that Christine Lagarde would agree with that. She says that she only spoke to Bessent after the transaction had been executed, and the broader mood out of the ECB officials seems to be that the spirit of cooperation was completely abandoned in this.
Yes, it's interesting, isn't it? Because when this first was announced, people started to ask, is it going to be like another Plaza Accord? Are we talking about devaluing the dollar here? And no, it doesn't seem as if we are. And we're not talking about the level of cooperation that we would have seen around the Plaza Accord either. So interesting parallels to probe. Coming up on the programme then, we will look at what we can expect from the US jobs data. We'll be joined by BlackRock's James Turner. We saw, of course, yields on the rise yesterday, very much to do with oil prices, in fact. But how does that position us as we head into this important jobs report? Are we nervous about a weak print, a strong print? What will spook the markets most? We're just going to be anticipating perhaps a lot of volatility given a lack of forward guidance now from the Fed. We'll get back into that conversation shortly. This is Bloomberg. Welcome back to the opening trade. 30 minutes this Friday morning until the start of the last trading day of the week. Let's have a look at the futures picture then for European stocks. We don't have quite the flurry of earnings stories to factor in this morning, and the handover from Asia was fairly tepid, just well, almost flat actually on the MSCI Asia Pacific. We seem to be in the depths of summer, if that's the right description. So this is the picture on futures. We're not expected to go very far on FTSE futures, CAC futures, or the overall European market. Nasdaq futures, for their part, then, Lizzy, are up 0.3%, and E-minis are flat this morning.
Well, I can't give you much more excitement in the bond space. We have got oil higher this morning, so up 0.75% at $83 a barrel. We'd seen Treasury yields up in yesterday's session. Now we're about a basis point lower across 210s and 30s. And you can see here in the European session, really not a lot happening at the open across the curve, across the European continent. But maybe we'll get some more action later, because it is, of course, Jobs Day stateside. Bloomberg Economics expecting a modest increase in non-farm payrolls and a slight rise in the unemployment rate. Traders will be watching the data very closely as they rush to hedge against potential swings in the dollar, and they'll be looking out for whether the numbers validate the Fed's rate hold last month. We can speak now to James Turner, EMEA Global, Head of Global Fixed Income at BlackRock. James, great to have you back.
Thank you.
Just hours away from the print. What would move the market most? A surprise to the upside, a surprise to the downside, and are you expecting a September Fed hike as things stand?
I think to start off with, is one of our themes is that really we don't want to be swung around, we're longer term investors, we don't want to be swung around too much by one single print, and I think that's the folly of the market in some ways, is that you get one print one way, one print the other way. It also, though, I think pulls into the theme why we're very reluctant to take longer duration at the moment, just because that's such a volatile area of the sovereign curves and government curves. In terms, though, of whether we think the Fed is likely to raise, we still have as our baseline is that we think rates will stay on hold for the rest of the year, although clearly that's the growth of the US economy, some of the pickup inflation is clearly pushing that towards a rate rise being more likely, but we still have a base case that there'll be no rate rise this year.
OK, so a hold for the rest of the year. Given your focus on the longer term, then, we've got this re-emergence of the debate around the Sell America narrative, and I wonder whether you think that's valid, because you've got the new style of communications at the Fed, for one thing. You've got the geopolitics, as we've been discussing, the fiscal concerns too. How real is the risk of a sustained foreign exodus from Treasuries?
So I think it's been, on margin, it's been happening anyway. But the truth is, when you look at, and we saw this around the tariff time, and there's a lot of talk about it, but actually I think the reality of it was a little less impactful, partly because when you look at the sheer scale of the US markets, they're enormous compared to the rest of the world. And actually, there's only so much you can do before you realise that there are limited, or not limited investment choice, but there's fewer investment choices than you imagine outside the US. And then a small amount reallocated away from the US is actually quite a large amount, even allocated into Europe, which again would then move the market, and I think has an effect of equilibrium, or causing equilibrium, which then makes the US market a little more attractive, and so you get capital flows. I think it was less, it's definitely something people thought about, definitely something that we saw on the margin. Just diversifying away a little bit from the US because of the risk. But having said that, I don't think we saw on a whole-scale nature. And clearly that's something that's probably more prevalent in fixed income than equities, because it's less of a choice in equities. So where people do want to do it, it probably is in fixed income, but it really is on the margin.
Yes, less choice in equities. Yes, it seems kind of almost crazy to ask that question when it comes to equities, but in the bond market space, maybe it lands a little more, but with the caveats you set out. Can I ask you what interests you with your global fixed income but EMEA focused head? What interests you about the yen intervention story and the dynamics there? Because it's really interesting the way that the Fed, the Treasury in the States wanted to support Japan in this, but they did it by, it seems, selling euros, not wanting to weaken their own currency. And does this show up as something that's relevant to the European government bond space, or is it just too small to matter there? What relevance does it have to Europe, apart from angering a few people at the ECB, perhaps?
And I think that's probably the most relevant. It's I suppose, a signifier of the fact that we've become a little bit less cooperative generally across the world. And that's causing more geopolitical risk, as we know, across the globe. I don't think actually the impact on European government bonds is going to be significant. But having said that, it's the signifier of that lack of cooperation. And again, I think, continues to push us towards really taking quite a cautious view on duration in terms of longer end. Short-term government bonds actually really in a very good yield spot at the moment. And we're very happy having that. But we don't really want to have that term premium risk just really because of these continual issues that we see in geopolitical risk and also uncertainty, I would say, in the long end.
So a lack of cooperation then globally is certainly a feature. What about when the AI rollout? We've referenced it in passing already, but let's focus in on that. The AI rollout and what that's doing in global bond markets. A lot of that issuance taking place in the States, but some of it in global markets as well. We saw it, I think it was well subscribed, the Alphabet issuance yesterday, investment grade credit. How is appetite in Europe for that kind of credit, do you think, right now? Are investors still hungry for it or cautious? They were more cautious maybe in July.
I still think actually they're receptive to it if it's priced correctly. And we saw that a little bit in the US where we saw spreads widen and then they've come back in again. And, clearly the news has been a little bit more positive recently. But actually the issuance in Europe hasn't been as perhaps large as people expected this year so far. And the issuance still to come for the second half of the year from the hyperscalers in general across all currencies isn't as large as the first half. So actually, I think there will be reception to it. It's got to be priced correctly. I think there's a little bit of a degree of caution. I wouldn't say people are hungry for it. But having said that, priced correctly, there's only really been two big issues in Europe so far. And I think there's certainly an opportunity for another.
James, more broadly in the corporate space, we reported earlier in the week about the bond market being on watch for a new era of fallen angels. And I'm thinking about Stellantis and Oracle, just some of the names that have debt trading close to junk levels. Yeah. I mean, are you particularly worried about certain sectors in Europe on this front?
I think the two sectors that are highlighted for fallen angels are ones that are just generally structurally weak at the moment. That's autos and chemicals. So they're likely to provide some of the fallen angels. Just as in the past when you saw structural weakness in, say, real estate a couple of years ago, they were providing the fallen angels as well. And this just happens generally. It's a healthy thing for the market. It provides opportunity. The truth is, though, by the time the company's actually downgraded into sub-investment grade, it's usually reflecting the spreads of a sub-investment grade company, and that's already the case with a couple of the names that you mentioned. So it's just a healthy development. It happens in ebbs and flows. It tends to happen, as you, I think, correctly point out, it tends to happen in sectoral trends, and certainly autos and chemicals are some of the weaker structural trends at the moment.
But do you think that Europe's especially exposed to all of this? If we're going to have an ECB hike in September, do you kind of separate the corporate fundamentals from the central bank story?
So I think in terms of the rate rise potentially in September, and I think that's like a high probability, I don't think that really affects the corporate balance sheet in a meaningful way, the 25 basis points. These have long-term maturities, they're well-financed. That's not the key thing. I think it's the actual underlying results that are affecting the companies more. But I don't think we have concerns over it. I don't think there's a wave of it coming in Europe. There's not a huge number of companies that are sitting in that BBB- category. And certainly the high-yield market is well able to absorb it. So I don't think it will cause any indigestion either. You tend to have this like ebb and flow between rising stars, falling angels, and it's a healthy dynamic in the market.
Phew.
Yes, well, that's a relief. James, we spent a lot of time at the beginning of the year talking about private credit and whether that might become something systemic that other markets, listed bond markets, for example, might be affected by. Then we got all distracted by developments in the Middle East and indeed the AI boom, and we stopped thinking about that a little bit. In the meantime, have things got better on that front? Is private credit looking less damaged? I don't know what that tells us about AI's strengths, but is that the case? And are you fielding fewer questions from clients on that front?
There's probably fewer questions because I think people have asked a lot of the questions that needed to be asked and had satisfactory answers. We still don't believe that this is systemic in any way, and I think that's been shown. It's just a natural evolution of the market in terms of we should expect it's effectively a market that is investing in sub-investment grade companies. So it shouldn't be surprising when you see occasional defaults, just as you do in the high yield market, just as you do in the leveraged loan market. So I think it's just a natural evolution of it, nothing to be too concerned about. But again, it goes to the theme that when you're dealing with sub-investment grade credit selection is everything as to get the best returns, because you really need to avoid that capital loss.
OK. James, thanks for joining us. James Turner, EMEA Head of Global Fixed Income at BlackRock.
Well, meanwhile, some Fed policymakers are warning that more needs to be done to bring down high prices.
Inflation is well above the FOMC's 2% target, and the balance of risk is tilted towards inflation remaining above target a year or more from now. Against this backdrop, it is crucial that monetary policy put a meaningful restraint on underlying inflation, rather than tolerating somewhat higher inflation today to pursue productivity growth tomorrow.
Alberto Musalem there, the St. Louis Fed president, of course, speaking in Sao Paulo. And we'll discuss the challenge for the Fed as we await the jobs report out of the US next. This is Bloomberg.
Welcome back. This is the opening trade Friday morning, everybody. And we anticipate not a lot of movement at the start of the European trading day. Of course, it is jobs day. And as a result, perhaps we're waiting to get a clearer picture on the US jobs landscape. We've also seen yields yesterday, really, not so much today, but yields going higher on the back of higher oil prices. So those are the dynamics sitting behind this pretty unch picture for European stocks then, Lizzy.
Well, while we wait for some excitement in the markets picture, let's take you to one of our top interviews now. Just days after his hedge fund was on the brink of collapse, Leopold Aschenbrenner has made his return to the investing scene, plunking down $400 million to back a privately held company. Bloomberg's Ed Ludlow sat down with the Sequoia capital partners Pat Grady and Alfred Lin, who say that Leopold approached the firm about taking over some positions.
It has been reported that we were talking with them about the Anthropic stake. You know, King Griffin showed up with what was a better solution for Leopold at that moment in time, and he went with the better solution. I think that our observation is that there is this game on the field over the last couple of years investing in the AI supply chain. Leopold was one of the first people to recognize that that was the game on the field. Yes. And on balance, he played it pretty darn well. And so our suspicion is that he's going to be a fixture in Silicon Valley for a long time to come.
I wanted to get to the Valar case study. We've talked a bit about Sean.
Please
go ahead. Yeah.
On situational awareness, he did just wire $400 million to a company that we invested in. So.
Oh, we actually reported on the $400 million, but I haven't got a clue who the company is.
Yeah, no comment on that. But he's
not.
It's
a good one.
He's not. He's going to be. He's really good. He's going to be around.
Well, Pat Grady and Alfred Lin also said that Sequoia was behind the curve when it came to investing in Anthropic.
This is the tectonic shift of our lifetime. In a perfect world, we would have backed Anthropic many years ago. We didn't. And so the best thing we can do now is to come in at the most scale that we can muster. And so $5 billion was kind of a theoretical number mentioned to be provocative. We ended up at 2.5 because we can't really do $5 billion across all of our different funds. And so 2.5 is kind of the most we can do. And that's sort of how we ended up with that number.
Is it fair to go as far as to say, like, how much money can we deploy without putting the firm at risk?
Yeah, that was part of the conversation. 2.5 or 5 would be comfortable numbers as far as that goes. But one thing, we've never done SPVs. We're not in this SPV business where you speak for something.
I think we have enough time today to talk about SPVs.
Yeah, so we don't do that stuff. And so $2.5 billion was what we could do out of the core funds committed capital.
Yeah. Let me ask you this, or give some background. Growth, early stage. Since 2017, you've led the growth, You've co-led early stage, but SaaS, consumer, but there's a lot of overlap, right? You have made significant growth stage investments and joined boards. You've made early stage investments, particularly in AI. Just talk a little bit about how the two of you see that progressing, forward looking.
I think it's very, very simple, which is like if you've been in this business a long period of time, you know what a good early stage investment looks like. You know what a good growth investment looks like. So Pat has been traditionally a growth investor. He made the early investment in Harvey. I've seen how early stage companies grow and advocated for growth investments in Airbnb and DoorDash when they grew up. And over time, I think if you've been in this business long enough, you'll make both early investments and growth investments. We have Constantine that championed Citadel Securities and Waymo. Yeah. We talked about Sean. We have David that has invested in a NeoLab that's relatively early. We have Sonia, who's recently sort of flew with me to London to advocate for the investment in Ineffable. So our team is much more fluid, and we don't. Just going back to like most of our partners don't like being put in a box.
That was Sequoia's Patrick Grady and Alfred Lynn speaking to Bloomberg's Ed Ludlow, Anna.
Let's turn to today's markets, broaden the lens a little bit, in 3 minutes on the opening trade with our Asia Markets Executive Director, Paul Dobson, with us this morning from Singapore. Paul, good morning to you from London. What do we make with a little bit of distance then of the yen intervention? We are currently at 158 on dollar yen. So the yen has given up half of the gains that it made since that intervention. And if the US doesn't want to devalue the dollar or sell any treasuries, does that raise questions about whether this is going to work or not? What are you hearing in the region?
Yeah, good morning, Anna. I do think that there are question marks around the intervention and whether you could call it a success. I'd say the jury is probably out in that respect. A rip-roaring success, I think the local commentators would say, would have taken the dollar-yen cross below 155. On the other hand, it's not like you can say that it has failed at this moment in time. We do have the yen reasonably decent amount stronger and away from those mid-160s that we were getting towards before the intervention took place. But I think there's another extra dimension to whether you can call it a success or not, and that is the unintended consequences that the action or the support of the US has raised this week. And it's sort of brought into a question several different factors. One, I guess, if you were the US people making the decision on this, you would think your very presence in the market would be enough to really reinforce and back down or double down behind the Japanese authorities. But I think that that hasn't necessarily played out all that much. And like you said, intervening by using the euro and shifting assets that way rather than a straight dollar support damps the message somewhat. And I think it's also raised some question marks about, how worried the US is about the Treasury market and higher yields too.
OK, well, in lieu of another intervention, as we await another one maybe, Paul, we've got the payrolls print coming out of the US this afternoon. How much of a reaction would you expect to see in the yen and JGBs?
Yeah, I think that the Japanese will be wanting to pay attention to it, Lizzy, because particularly a weak number, which pushes the dollar down, could be helpful in supporting the yen. But on the flip side, a strong number that gives people more reason to suspect the Fed might be able to move towards hiking at some point soon. Could be another reason to push the dollar higher and therefore to weigh against the yen again, and therefore raise those risks of another intervention in the market at those times towards the end of the week when we're seeing less liquidity.
And what about the Treasuries market and how it's positioned going into this number, Paul? Of course, yesterday was all about higher oil prices and therefore higher yields. Mm-hmm.
Yeah, exactly. So the Treasury market is also going to be on edge as well as the Japanese bond market. We've got those yields very close to the highs of the recent cycle. And I think that the market is looking for 80,000 for payrolls. That's a pretty decent number. I think that would be enough to convince people that the economy is looking okay without being worried that, everything is going overheating. But a bigger number than that, we might see more of a sell-off. The market is pricing or leaning towards a Fed hike at some point, but it's not really convinced yet. So a big number, and they might lean more into that and push up those yields further.
All right, Paul, thank you very much. That's Bloomberg's Executive Editor for Asia Markets, Paul Dobson. Now, let's get to our stocks to watch this morning ahead of the market open. Alex Morgan has those for us. And Allianz in focus with earnings out this morning, Alex.
Yeah, good morning, Lizzy. Happy Friday. Yes, Allianz, there's been a focus here, of course, a lot of a deal-making spree in Asia. Allianz taking on HSBC's insurance firm in Singapore. That's going through less than 2 years after a similar deal fell through. So there's this deal spree going on behind. You can see year to date up around up around 13% year to date for Allianz. And the group operating profits, up 11%, beating estimates from analysts. Let's turn it over to Italian banks. The ongoing, talking about deal sprees going on in Italian banks. Monte Paschi out today, a bit of a tailwind for the CEO amid this offer from Intesa, this takeover offer. Just a month after Banco BPM withdrew a merger of equals. So, of course, situation at Monte Paschi, whether or not they're going to accept this approach from Intesa. They say the price being offered is too low. You can see that these earnings today, which are stronger than expected second quarter profits, giving a little bit of tailwind to the CEO and the board going forward. Let's just finish up on Daimler Truck. And this is an interesting one. Down around 7% on Tradegate this morning. Tariffs, according to the CFO, weighing on their North American business. And that is where we're also getting details about a new factory, which the CFO on a call a matter of minutes ago saying will be the largest to date for Daimler Truck. Let's turn it over to John O'Leary, head of the North American side of the truck business, saying that they want to have the best, most modern plant out in the United States, knowing that will give them the best cost position. But down on Tradegate this morning, after, as I say, those tariffs providing a bit of a shadow over the picture. We will keep an eye on these and some other names when trading gets underway very shortly.
Alex, thanks very much. Thanks for that. So a number of companies in focus. We don't have a lot of corporate earnings, Lizzy, this morning. Munich Re is another one I'd just add to the mix because they've cut their insurance revenue guidance for the full year, even though some of the backward-looking numbers look pretty good against estimates. So we'll keep an eye on that one. We've talked a bit about insurance this week.
We have, in the context of wildfires. Really interesting conversations, actually. No one really wanting to put numbers exactly on the damages from the wildfires, but everyone seemingly saying it's better to do prevention and nothing is uninsurable.
Yes, absolutely. That's the message coming through from one of our conversations yesterday. We will be back with the market open on the opening trade. Futures are pretty flat this jobs day. This is Bloomberg. A few minutes to go then until the start of the last trading day of the week. Is Friday, everybody. This is the picture from Thursday's session, in fact, over in the United States. And it doesn't give us much of a sense of where we're going in the European trading day because a lot of the action really happened in the earlier part of the US session. After the European markets closed, we didn't see a huge amount of movement. And in fact, the futures picture for Europe does not suggest a huge amount of movement at the start of the trading day today. So we're pretty flat on these markets. We are not seeing a whole lot of earnings reporting today, so that's one of the dimensions. We factored in the higher oil price to some degree yesterday. That was certainly what was driving fixed income markets, and that weighed in some places on stock markets as well. So higher oil prices yesterday due to a lack of progress really around reopening the Strait of Hormuz. That certainly increased yields on Treasuries and to some degree in other parts of the world as well. And we saw that filtering through into stock markets. So we have muted expectations on jobs day, Lizzy, that we go very far at the start of today's Friday session.
Well, let's take you through some of the stocks to watch this morning. Not a hugely busy day for earnings, but just a few to flag. So Daimler Truck in focus, indicated lower on Tradegate. This after its second quarter revenue missed estimates. It is also, though, eyeing a new US plant. We've been hearing from the CFO on the analyst call saying that this new factory will be its biggest in the United States. Also keeping an eye on the insurers. We've heard from Allianz and Generali, profit beats from those two. But Allianz has an income miss, and maybe that outweighs the PIMCO flows in the eyes of investors this morning. Just finally, Lanxess, the German chemicals maker, EBITDA for the second quarter meeting estimates. They've confirmed their full year guidance. But is the result going to be positively received in these markets? We shall see at the open, Anna.
Absolutely. And all of this coming ahead of the jobs report, of course, which adds a big global macro data point to later on in the trading day. So perhaps, well, on days like this, we often don't see a huge amount of movement before the jobs report. That's not always the case, but is often the case. So the FTSE 100 not moving all that far this morning. Maybe the data points out of the US then take on greater significance because we don't have quite so much forward guidance from the Fed as we used to. A detox, as Scott Bessent has been calling that particular phenomenon. So whilst we're in the midst of that detox, maybe these data points take on a whole lot more meaning and can provide more volatility. Maybe the market acutely aware of that and therefore reluctant to position particularly aggressively ahead of the data. So we're up by 0.1% on the stock 600. The FTSE making very modest gains. The CAC 40 also up 0.1%. In fact, that seems to be the size of it then, Lizzy, this morning. All the markets that are open up by 1 or 2 tenths 0.1%. What do you see in the sectors breakdown?
Well, we've got fewer than half of sectors in positive territory. Energy leads the gains today, as you would expect, given that we've got higher oil prices off the back of the latest in the Middle East, the disappointment that there isn't progress on a deal, and the fact that there has been this step up in tensions. So as we see Brent trading up 1.2% at $83 a barrel, we see energy at the top of the sectoral basket up 0.7%. Healthcare and tech not far behind, basic resources as well, but bottom of the basket today you've got media, consumer products and services, retail, travel and leisure. And if we just go back to some of those individual names that we were flagging, waiting for many of them to open up in Germany, as is per usual, but we do have Monte Paschi shares up 0.7% off the back of their earnings, and we're also looking at Porsche shares up 0.3%. We've heard their results out today. VW at a crossroads, according to the Porsche owner, got to change quickly, but we saw a first half loss after tax for Porsche this morning.
We've got some interesting moves in healthcare. You mentioned the sector is in focus, and in fact to the upside, the biggest points contributors on the upside of the stock 600, we've got at least 3 healthcare names within the top 6, I think it is. So certainly a day where healthcare is doing pretty well and bringing a lot to the stock 600. Let's talk about where we are on these markets more broadly. Farhad Kamal joins us, Chief Investment Officer over at Coutts. Farhad, nice to speak to you. So broadly speaking, you are overweight risk because you still think that growth is very positive, labour market data remains supportive, and AI investment continues. So that's a positive cocktail for you. For how long does that cocktail endure, do you think?
Well, it's been going on for 3 years, frankly, right? And we've been overweight risk for 3 years on exactly that. Not that there haven't been risks, not that there haven't been lots of things to worry about, as they are today. But frankly, the underlying macro picture has been so supportive, and that's been really, really good for earnings. The AI trade is adding a huge multiplier effect on top of everything else. And for the foreseeable future, that continues. Everything that we've heard in the earnings reports would suggest that this carries on for now.
OK, and what would make you question that? What would make you turn more cautious? I'm thinking in particular, you said about CapEx and AI CapEx. What is it specifically about AI CapEx that improves our risk sentiment and what detracts? Because it seemed to be, in particular, the cloud providers that were met with positive market response to their earnings. So what are you watching for in AI?
Look, we obviously, at the heart of everything right now is this positive macro story. An enormous contributor to that is this AI story, right? So we're talking about, in the US alone, something like 2 or 3 percentage points of GDP growth being generated just by this, 700, 800, almost $1 trillion worth of AI spending every year. Now, if that starts to reverse or go the other way, it's the opposite of the multiplier. It becomes the divider effect, right? And then suddenly the chances of recession, slowdown, labor market weakness, etc., start to exacerbate. That's the biggest risk, right, is recession, and AI is a massive contributor to that. In addition, obviously we are clearly, like everybody else, focused on what's happening in the geopolitics of the world. Who knows, right? We're on our 10th round of negotiations or whatever, and it's been going on for a while. At some point, the boy that cries wolf is clearly the parable that comes to mind. But that's the other worry that's on the horizon. Not so much because of the geopolitical tensions being what they are, but clearly its impact on inflation. That is, and the monetary paradigm that may result is the other big worry.
But let's say you get the Strait of Hormuz reopening to shipping, not just for friends of Iran and Oman, but more widely as well. How much would that change your outlook for the second half of the year?
Yeah, but amazing, right?
Yeah.
I mean, like I said, there's a pretty good picture already forming, right? Macro, labor markets, etc. You take away the geopolitical risk premium, and you're off to the races even harder than we've been for some time. I think, obviously the friends and family discount that's being discussed right now is interesting. I don't think that'll be acceptable, frankly, to the US. But I think Iran is playing hardball. In the end, though, our base case is that there is going to be a negotiated settlement that everybody can live with.
Whenever that may come. And just going back to AI, how are you thinking about the threat from Chinese competition to American AI? Is it like good enough and cheaper will win?
Who knows? I mean, I think one thing is pretty clear. We don't need frontier, next level models to check up, butter chicken recipes, right?
Is that what you're doing?
Yeah. I mean, is that not what everybody's doing? But so clearly there is no question about the fact that there is going to be a paradigm that results that you don't need this a Ferrari to go to the grocery store at every time, right? So that's going to change, and clearly this is good. I think the competition and the questions that this asks is good. Nonetheless, this is an innovative frontier technology. The US remains in the lead, and that's where we think that that's the paradigm that we see going forward. Yes, the Chinese are asking very interesting questions, but that's part and parcel of innovation, and that's good, I think, for the broader macro picture. Ultimately, the real win for us is not who's going to win, which companies are going to make the best chips. It's the productivity gains that come to the macro, to the global economy.
But when do we get them?
Already happening. Okay. It's already happening.
Where do you see that evidence? Which data do we mine to see that then, Farhad?
I mean, even just yesterday in the productivity print in the US, the Fed, you clearly saw quite a strong gain. There's undeniable, even if you look at a 10-year smooth productivity chart, you're seeing a clear upside happening, right? One of the greatest ways to quantify that is margins. Look at the margins of the S&P 500, 16.5% right now. That's a record high. Usually we'd be really worried about margins that high because they tend to mean revert, but they're not mean reverting. They keep going up. Clearly, companies are finding productivity gains. AI is part of that story.
But when does that become a viable argument for the Fed then, as Kevin Walsh would like to make, to not need to be hiking rates?
Well, clearly, if productivity gains are coming, they're not necessarily inflationary, they're disinflationary, right? So that will come eventually, and that will feed through to the data. Right now, clearly, because we've got this huge AI capex spending, as well as productivity gains that are just beginning, there's a balance to be had. I think in the very short run, a lot of this AI is probably inflationary, so the Fed needs to worry about it. But in the long run, 3 years, 5 years, 10 years from now, the productivity gains become quite disinflationary.
You think a lot of the froth has come out of, and I guess retail participation might be one way of measuring that, come out of the AI trade. Is that just in reference to Korea, Farhad, or is that globally you think we've kind of, after July, we've backtracked sufficiently to regroup and move higher again? Is that the story?
Well, Korea for sure, right? I mean, Korea for sure. But also, I mean, just look at even last week, the hedge fund, the situational awareness. Yeah. Clearly, that alone, I mean, obviously we didn't know in real time, but in hindsight, we could see a lot of what was happening was a result of this enormous forced deleveraging that was taking place because of just that one fund alone, right? Clearly, there has been a huge amount of retail froth and hedge fund excesses, etc., leverage built in the system. I think over the month of July in general, we saw a lot of that unwind. Yeah. It would appear.
And what do you make about broadening narratives, Farhad? Do you think they are healthy because but the AI boom can continue as the market broadens at the same time, or is the broadening a reflection of doubt in AI?
Not at all. I mean, I think it's a super help. Look, for the last 3 years, everybody's been super worried about how concentrated this market was, right? Yes. You can't have been worried last year about concentration and now be worried about the fact that it's broadening. You have to pick. We are definitely in the camp that we were super happy when it was concentrated because we were riding the wave up, and the fact that it's broadening out right now is just a reflection of the thesis that the underlying macro picture is broadening for everybody and earnings are improving quite broadly.
Can I just finally ask you about defence, because we've got the Rheinmetall CEO on the show this morning. How are you feeling about this? Because it's been one of the standout trades of the past 2 years.
Look, ultimately, all equities on Earth, any sector, it's ultimately a function of what you expect the future earnings to be. Clearly, the geopolitical paradigm shifted quite dramatically since the new administration in the US came into power, and that has been massively earnings positive for defense. That's a fact. And it's not just one company, it's quite broad across the sector. We know everybody is going to be spending a lot more in defense in a world where the liberal rules-based order that we've been used to for the last 70 years is disintegrating. That is going to happen. That's good for defense and good for earnings ultimately, and that's quite clear.
Okay, Farhad, really nice to have you on the programme this Friday morning. Farhad Kamal, CIO over at Coutts. Thank you. Well, speaking of Rheinmetall, let's check in on the Core 6 this morning, and its shares are up 1.2%. We have gains for Novo Nordisk today of 3.8%, but not a lot moving when it comes to ASML or Schneider Electric, or indeed Nestle this morning. So let's look for a bit more excitement, shall we? We can go to our individual stocks on the move with Alex Morgan. What are you watching, Alex?
Well, good morning, Lizzie. Let's start with energy this morning, and an interesting picture here, a jump for General Energy after rejecting an approach by Norway's DNO. You're seeing General up around 5% this morning, straight into the green, but the jump actually is around 14% after the rejection of the approach from Norway's DNO, saying that was a £202 million approach. And you can see in terms of what that's done for General this morning, given them a lift. DNO, though, still, of course, up around 2%, also in the green. Let's turn over to chemicals. Lanxess here down around 2%. The German manufacturer of chemicals, but also rubbers and plastics. They're in the red this morning, down, as I say, around 2%. Let's keep the German theme and turn over to Daimler. Now, Daimler Truck. Yeah, we had those that missed this morning in terms of the profits going forward, looking to North America in particular with the talk of tariffs. We've heard from the CFO on the analyst call about this new factory that they're going to be building out there, going to be the largest to date. Yes, in a bid to get around the tariffs and to mitigate those impacts, but also talking up the technical capabilities it'll provide them. But Daimler Trucks in the red this morning as we open around about 2%. Let's turn over to Genmab, the drugs manufacturer. They had earnings after hours yesterday, which beat estimates up around 7% this morning. Of course, they are heavily in the cancer treatment. Their earnings, you can see, really giving them a bit of a lift this morning, beating what analysts were expecting. So some after-hours impact into early Friday. And finally, let's finish with... It's Friday. Let's finish with biscuits. Lotus Bakeries, of course, the maker of Biscoff, they beat this morning, up around 3%, straight in the green this morning. So a bit of a blend for you there, but yeah, finishing off a Lotus in the green.
Thank you very much, Alex. Yes, appropriate for this time of day, I suppose. Alex Morgan with the stocks that are moving this morning. Lizzie was just talking about the defence sector, and we'll pivot back to that theme shortly. Coming up on the programme, Rheinmetall's CEO says he is very unhappy after losing a €10 billion naval contract. We'll have more from that exclusive interview here on Bloomberg. This is Bloomberg.
Welcome back to the opening trade. 16 minutes into today's session, and this is the picture across European markets. Just 17 minutes nearly into the open, and we're up 0.25% on the Stock 600. It is a quiet day for earnings here. We're waiting really for the US payrolls print later on today for a bit more action, but outperformance in Germany. Anna, I think you're minding the Italian banks this morning.
Absolutely, keeping an eye on what's happening to Monte de Paschi, the share price there, because we've had numbers out from that business. So the share price is up by just shy of 1%, but there's a lot more than just the earnings contributing to the Italian banking story right now. The Italian bank did report profits that exceeded analysts' expectations. The earnings beat provides a tailwind for the CEO, Luigi Lavalli, while he considers how to respond to a takeover offer from rival bank Intesa. We're joined now by Bloomberg Rome Bureau Chief Chiara Albanese. Chiara, good morning to you. So what are the key takeaways from the earnings then? Because we'll get on to the takeover story in a moment, but what do the earnings tell us?
The earnings are painting to us a very good picture, a picture in which all the banks that have reported so far, so most of them have beat the estimate on the back of a strong quarter and a strong semester with interest rates rising again. But there is more to the picture because what the market and analysts were really looking for in these reports were indications about all the M&A wave that is taking place at the moment, which mostly rotates around Monte de Paschi di Siena. And we have the CEO Lovaglio speaking just now as we are on air.
Yeah, I mean, take us through the latest there on the takeover story, because, of course, these numbers are a tailwind for the Paschi CEO. But where are we on the bids, the strategic options that they say they're considering?
That's a great question. So Monte Paschi has been subject of a takeover offer by Intesa Sanpaolo, which will formally kick off in autumn. And at the same time, it was in talks with Banco BPM for a potential merger of equals, which though has been abandoned. So there is a lot of speculation about whether Monte Paschi could still do something with Banco BPM to fend off the offer by Intesa, or what he will do next. And of course, in this picture, there is UniCredit that is continuing to pursue Commerzbank. And what will it do after the Commerzbank deal has been sealed is the big questions everyone is after.
Yes, Chiara, it's interesting, isn't it? What's the Italian government's attitude to this consolidation within the Italian banking sector? Because we've had a number of guests who talk about the need for consolidation cross-border, but then we get examples of consolidation even within country that seem to be challenging.
Yes, so the Italian government has been trying to remain on the sidelines of this action. It has a residual stake in Monte Paschi that it is aiming to sell in the next months, just also to project the sense that it is not going to interfere with private decisions. But we know that, of course, officials are fully briefed on the latest and are involved and monitoring closely, because what's at stake is the stability of Italian financial system.
Chiara, thank you very much. Thanks for joining us. Chiara Albanese, Bloomberg's Rome Bureau Chief.
Well, let's turn from Italian banks to German defence. We're looking at Rheinmetall shares higher this morning, up 1.7%, but they took a hit yesterday after they cut their full-year outlook following Germany's withdrawal of a €10 billion naval contract. Bloomberg's Francine Lacroix spoke exclusively to the CEO, Armin Papaga, yesterday, where he discussed his thoughts on that contract loss.
I am very unhappy that we lost the F-126, but at the end of the day, there is an impact, but it's not a huge impact. The naval business is at the moment the smallest business of Rheinmetall, and we will have an impact this year of about €300 million in sales. Mm-hmm. This is exactly what we took out also from our guidance. But this business is on a level of 10%, so between 20 and 30 million, with an EBITDA of 3 billion. So you see the impact is very small on the profitability.
Could this actually lead, though, to a slowdown of the production ramp up?
No, not really, because we have such a wide product portfolio that I'm sure that we can, over the next years, compensate or overcompensate also these areas. We are fighting hard, and I have a great team, and the people compensate a lot. So we stay on the expectations, and for next year and also the years after next year, my expectation is that the growth rate is still more than 30% per year.
So what exactly will compensate for this loss of contract? Is it autonomous vessels? Is it smaller boats?
This is one point. On the other point, we are looking for international and other national contracts. And I'm sure that also Germany will give us some contracts, because we have the biggest shipyards over water here in Germany. And Germany needs these capacities, and I'm sure that we will find a good way.
Have there been any developments on your bid for the German naval yards?
We gave a non-binding bid on the German naval yard, and at the moment I can make no decision, because I have to wait that we get more contracts. With the F-126, it was a need. Therefore, that was the reason that we gave this bid. Now we have to wait, and we will see over the next 2-3 months if there are new contracts coming in, and if yes, then we will continue.
Do you worry, sir, that actually there are other things like the frigate F-127 that will be called into question by German lawmakers?
I have no idea at the moment what really is coming with the F-127, because the German government at the moment is looking forward to say, okay, we have to reduce the cost structure. And we are in negotiations at the moment. You know that we are in a consortium with TKMS on the F127, and we want to do what is good for the customer at the end of the day, but we are also flexible.
I mean, Germany appears to have also decided to open the tender up to others for the procurement of the collaborative combat aircraft instead of going with the Rheinmetall Boeing product from the start. What do you make of this?
Competition is always good. Germany is looking at the moment for different solutions, and at the end of the day, the best solution should win. We go with Boeing Australia in that area because we believe that this system at the moment is a modern system and is the most qualified system at the moment. But it seems to be that Germany wants to go like on the drone business with 2 or 3 different competitors, and that's really good, and that's fine for us.
Rheinmetall CEO Armin Papiga there speaking to Bloomberg's Francine Lacroix. Well, it takes us to a broader conversation about defence, I think, and the future of the defence industry in the context of what the future wars are going to be in the world. And there's a really interesting piece from the Wall Street Journal this morning saying that there have been these US intelligence reports that Putin in Russia could try to test NATO by launching a limited assault on an ally in the next few years. And that's been something that really has been dismissed for a long time. But it doesn't have to be a low-level land assault. It could be a cyber attack. And we just don't know what the response from NATO would be. You know, how does Article 5 stand up if it's just, she says just, a cyber or a hybrid threat?
Yes, and people are have been asking questions for some time about the hybrid nature of the warfare that might need to be fought against Russia, and to what degree is Russia already experimenting in that regard with small incursions of drones into parts of NATO airspace. We saw that the shutting of the Leipzig airport this week, and a lack of clarity really as to what exactly happened there, but there did seem to be unexpected objects in the air. Ukraine, it seems, is asserting itself back onto the market's radar as well because of their success in hitting energy infrastructure in Russia, but then their lack of success in firing at Russian missiles or bringing down Russian missiles because, of course, they don't have enough interceptors, and that takes us back to the Iran conflict. Yeah,
but it also takes us back to this Wall Street Journal story, because why would Putin want to look at NATO members? Because he is increasingly squeezed in Ukraine and he needs to secure a victory at home.
So lots to think about when it comes to the defence landscape right now. Coming up on the programme, we will pivot back to markets and to M&A in particular. We see more undervalued UK companies becoming takeover targets. We will talk to Kate Cooper, a partner in the M&A team at the law firm Freshfields, about what is driving this wave of M&A, including around EasyJet. This is Bloomberg. Welcome back, everybody. This is the opening trade. It is Friday. It's jobs day in the States. So not expecting a huge amount of movement perhaps on European stocks in advance of the jobs report. But actually things do look more positive than they did at the start of the trading day. We opened pretty tentatively, bit of a Friday feeling perhaps to these markets. But the DAX now up by around 0.5%. Overall on European markets up by around 0.25%. Healthcare stocks seem to be doing pretty well. Energy stocks not doing too badly. We see a higher oil price, again to do with a lack of progress in the Middle East. And so we see energy not doing too badly. The opposite side of that is travel and leisure not doing too well. But healthcare is the best performing sector across European markets then, Lizzy. What do you see under the hood?
Well, by way of illustrating what a quiet day it is as we wait for that payrolls print out of the US at 1:30 p.m. London time, just look how low volume is, down nearly 30% this morning. But a pretty even split between members to the upside and the downside. Again, it seems like we're waiting for a catalyst here in this market. So let's take a look at some of the individual movers for a little more excitement. We've not got that many earnings out today, but Genel Energy up 13%. It's rejected an approach from DNO, so that's what's moving that stock. Genmab is higher on a higher outlook, up 6.4%. And Goodwin, the industrial company here in the UK, has started a strategic review. Shareholders like it. We're up 13% this morning. Now, flipping over to the laggards, we've heard from various insurers, but Munich Re is one of them with results. Revenue, we've beaten estimates when it comes to their results. So we're down, though, 2.7%. Lanxess, one we'd flagged, second quarter adjusted EBITDA, meeting estimates. They've confirmed their full year guidance, and yet they're being punished, down 3.5%. We've also had a revenue miss for Daimler Truck. Those shares, a bit more of a logical reaction, you might say, down 2.8% at the moment, Anna.
Let's get an update then, Lizzy, on some of the other stories we're following this morning. I mentioned oil prices on the move, and they're extending their gains, a jump sparked by Iran attacking, quote, hostile targets in the Strait of Hormuz. Tehran is also reported to be seeking to bar US and Israeli ships from the waterway in a deal with Oman. According to the Financial Times, the European Central Bank was only made aware of the coordinated US-Japan yen intervention, where the US sold euros to buy yen, after it was executed. The yen has now given up half of its post-intervention gains, in part after the dollar notched its best day in 2 weeks. Alphabet has sold $25 billion of investment-grade bonds in one of this year's largest order books for AI-related debt. Helped by generous yield payouts, sources say Thursday's offering attracted some $115 billion of peak demand. The sale lifts Alphabet's debt issuance since 2025 to more than $114 billion, making it the biggest seller of AI-related bonds over that period. Lizzy.
Well, let's turn back to the M&A story now. Apollo agreeing to buy EasyJet for £5.7 billion, clinching a deal that's likely to shake up the dynamics in Europe's highly competitive market for budget airlines. We can go now for the detail to Bloomberg's aviation reporter Danny Lee. Danny, what do you think put off Castlelake in the end?
Well, Castlelake had a very different plan to Apollo, who was the victor for EasyJet. And I think for Castlelake, balking at putting in a higher price, given that there was speculation they may look to potentially break up the low-cost carrier, they felt like maybe the valuations required to buy EasyJet relative to everything it has, its assets, was probably a little bit of a bit too far. However, one of the key parts of this is also the fact that EasyJet also had, Stelios, the founder of EasyJet, had come out in favour of Apollo. So with 15% of the shares, the largest shareholder, that really put Castlelake into a corner. And on top of that, it also has this question around its shareholding, potentially as a foreign entity, non-EU shareholding, which would have made it very challenging and put scrutiny on regulators of this takeover as well.
And so what does the success of Apollo, what does that mean for the future of EasyJet then, Danny?
Well, I think for EasyJet, the fact it now has a very well-capitalized new owner waiting in the wings, so to speak, the fact that Apollo has outlined its ability to support EasyJet and to do so, allowing them to grow behind the scenes without having to have shareholders demanding more and quicker returns. So at the end of the day, EasyJet has a lot of support to grow sustainably and potentially to grow more ambitiously. The fact that you will have them already in a lot of major European airports, they'll be in a better position to put up more of a fight to a lot of the legacy carriers. Of course, you've got the low-cost carriers like Ryanair as well. But yeah, the fact that Apollo does have a plan to double down on some of its bets related to EasyJet, and that will be sharpening the competition in the European landscape.
Danny, appreciate the context. That's Bloomberg's aviation reporter, Danny Lee. Well, EasyJet isn't London's only takeover battle. Foreign and private equity buyers are aggressively snapping up undervalued UK companies at record pace. With London's IPO market frozen, these buyouts are rapidly shrinking the exchange while leaving investors with few other ways to exit. Kate Cooper, a partner in the M&A team at law firm Freshfields, I'm pleased to say, joins us now. So, Kate, this really is your expertise. And you've said that we're in the year of the bear hug, where you have foreign investors wooing shareholders in London-listed companies with takeover offers that are basically too good to be true or seem like it. Just first off, for anyone unfamiliar with a bear hug, what's the difference between that and a pure hostile bid, and why has it become such an effective tactic right now?
Yeah, well, thank you. This is something that we're seeing this year more than we have done in recent years. Really, if you think about it, most takeover approaches, they're always unsolicited because, people don't put themselves up for sale. Companies aren't out there saying, please buy me. But what happens is that bidders are coming to companies in private. Generally, they attempt to get the board to agree a price. They give them a whole bunch of commitments about what they're going to do to get the deal done, and they try to convince the board that they're the right custodian of the business going forward. And obviously there are transactions that play out that way. Like, we saw the Swedish industrial tech company ABB offer for Mitti a couple of weeks ago, exactly that playbook. But what we're now seeing, and has been really a feature of the last sort of few months of activity, is really determined and assertive bidders, and they're deploying these bear hug strategies, right? And those are where they're going around the board and they're going, to do exactly what it sort of sounds like. They're making a very public declaration of love for these companies in the shape of offers at a real premium to the trading value. And they are saying to shareholders, this is what we're prepared to do. And they're asking the shareholders to put pressure on the board to engage. And so, in the same way as a bear hug, that's actually a pretty suffocating embrace to be on the receiving end of if you're a target board, right? Yes. And it takes the control out of the target board's hands to a greater degree and really sort of just turns the tables slightly in favour of the bidder. If, of course, shareholders are vocal and in support, it's a judgment. But if they are, then can be really quite helpful. And we've seen it deployed time and again this year. Zurich Beasley, EQT, the Swedish buyout group's offer for Intertech. There's Prologis Segro. There's happening a lot.
Well, let me take the Prologis Segro example then, because I think it was multiple bids it took to get that over the line. When you look at the board, does it make you think that they're just getting in the way, or is it actually that they're doing their job by getting in the way and really considering trying to get the best offer?
Look, I think it's the latter. Boards have a duty, right, to extract the very highest price they can, but they've also got a duty to, deliver the deal. So they're going to look really forensically at whether a bidder can actually come through with the offer, like you're seeing with the EasyJet situation. You can see that the board there have really scrutinised the deliverability of that deal by Apollo in the announcement. But there comes a point where boards are under pressure themselves. They've got a shareholder register potentially that's quite sort of fractionalised. So we've got fewer long-onlys sitting in stocks who are, the ones who traditionally back the boards, the insurers, the pension funds of the world. There's a greater proliferation of shorter-term investors. They want action now. And actually, boards are sort of saying at a certain point, well, it's over to you. You're going to have to decide whether this is something that you want to accept. I think the key thing, though, is that these are not opportunistic deals. Private equity in the past, I think, has been accused of opportunism. You can't make a bear hug with a skinny premium. You are going with something that's really, a full offer. Otherwise, shareholders are going to laugh in your face.
And so we are seeing then a lot of private equity bidders in the London market. Is that the case then at the moment, Kate? Because on the other side of things, we're seeing a low level of IPOs, which means when those private equity companies want to get out, exits are more challenging. They have to find another firm to sell it to, another company within the space, or another PE, another private equity business. But is that not weighing on their willingness then to get involved in M&A in the London market?
I actually don't think it is at the moment. I mean, if you look at the last sort of few months of activity, private equity have been right at the heart of it. So have the strategic acquirers as well, frankly. And, we're seeing the strategic acquirers potentially using M&A again as really, a way to fuel growth. And it's a good ballast, often scale in amongst macro uncertainty. But for the private equity acquirers, they are out there. There is both debt and equity available to fund these. I mean, you can't do these very large take-privates like EQT's bid for Intertech unless there's a great availability of capital. So the appetite is there. And I think there are some really, really high-quality assets that, private equity can't ignore because they need to deploy capital. And then they have to think about the exit in due course, of course. But they're not going to not deploy.
Is the conversation very much around the UK just being very undervalued at the moment, and that's why the opportunities exist here? Or is this a broader European story, do you think, Kate?
I think it's a European story. I mean, look, London is a global financial centre. There are, international capital flows coming into it. The companies that are being acquired at the moment are sitting at the higher value end of that spectrum. They're FTSE 100 companies. They are internationally relevant businesses with big footprints, diversifying risk, and those are incredibly attractive. And what is happening is that the premia that are being offered are really very full at the moment. So there's, 40, 50% plus. Look at the EasyJet offer. You can pick your number there. And so I don't think it's a case there of those companies being undervalued, but the value is genuinely being recognised in these transactions in a way that perhaps it wasn't before.
But specifically in the UK, to what extent does the relative political stability that we're starting to see with the Burnham government change the picture for deal decisions? I think you've talked before about how political uncertainty can be bad. Now that you've got Labour recovering in the polls under Andy Burnham, is that good for the deals environment? And when you're thinking about how to stop the hollowing out of the market, how would you advise the Burnham administration to stop that?
Well, that's a very difficult question, isn't it? And there are going to be people far more qualified than me to answer that. I'm an M&A lawyer. So, I see this as, really a natural flow of capital. The answer to this is not to think about, stopping M&A. It's about thinking about what are the incentives to bring companies up and into the market in the first place. Other people are far more qualified to answer that. It's a myriad, lots of different solutions that there could be out there. There's pension fund allocations, there's, looking at stamp duty, there's looking at the investment incentives, lots and lots of things that can be done. But, if you're actually looking at M&A, that's a good thing, because actually it shows that the businesses that are in the UK and that are headquartered here, are very high quality businesses. And I think the other thing that I find slightly difficult as a characterization is that this is foreign bidders taking over UK companies. This is international acquirers taking over international businesses. They happen to be headquartered and listed in the UK. Yeah. And actually, one of the things that we see here, again, the Apollo commitments in relation to EasyJet are a good example of this, is that UK investment is not changing. In fact, it's being enhanced in a lot of these takeover situations. They're putting capital in. They're trying to grow the business over here. The headquarters are not changing. The R&D, the employment isn't changing. So I think it's a bit of a mischaracterization.
Okay, yeah, really interesting on that pipeline of new businesses coming in. I was looking at some stats on this. The share of UK companies that are listing at home was 46% in 2025 and 71% in 2019. So that has really declined. US companies, especially if they're tech focused, increasingly, drawn to the magnetism of New York.
And just look at Nscale, targeting a September IPO in the US. Just the latest case of a big UK AI company looking elsewhere.
Kate, thank you very much. Thanks for joining us. Kate Cooper, partner at Freshfields on the M&A stories here in London. Coming up on the programme, we'll get back to the oil narrative. Oil climbs as a deal to reopen the Strait of Hormuz remains elusive. We'll bring you the latest. This is Bloomberg.
Increasingly, extreme heat and drought affect refiners' ability to produce fuels efficiently. So we have simultaneous raising of demand and constraint in supply.
We do everything we can to absorb those costs, but yes, food pricing has become more volatile, also driven by weather volatility.
In order to drive down energy prices, we also invest into sustainability measures. You may have read in our press release that we have now put some wind turbines in one of our German plants in order to drive down the energy cost and make us more independent from market fluctuations.
It's something that we have to deal with in our supply chain. but not something that I would dare to predict for the coming years.
Now is not the time yet to verify and see evidences of El Nino, right? I mean, this is something going to materialize inflation-wise, output-wise, towards the end of the year, beginning of 2027. I do believe, and I take El Nino risks as one more reason for central banks to be cautious out there.
To really give you numbers, it's too early. I mean, things are still happening here. But what is important here, we need to understand the risk, we need to mitigate the risk, and then we need to basically give protection here. And there's still a big protection gap here that people are not covered for the remaining risk here.
A few of the guests we've been speaking to this week discussing the challenges facing Europe amid extreme weather volatility. And Lizzy, the place where climate meets markets, we've heard quite a bit this week, haven't we, around climate change, heat and drought. That's one way that these themes interact, but also everything we're seeing in the Strait of Hormuz and the availability of energy out of there increases the need for more resilience at home.
Absolutely, and we're looking at oil higher again today, up 0.9% to $83.25 the barrel on Brent. The gains continuing because we've had Iran saying that it's going to seek to restrict US and Israeli ships from the Strait of Hormuz. We've also got a deal over the vital waterway really remaining elusive. So let's get the very latest. We can go to Dubai and speak to Abir Abu Omar, our Horizons anchor. Abir, we've got conflicting comments from Washington and Tehran. It seems like what Tehran's proposing, Washington couldn't possibly agree to. What do you make of it all? What's the latest?
Good morning, Lizzy. Yeah, despite the fact that historically U.S. and Israeli flagged ship never really made it through the Strait of Hormuz, but it will be very unlikely for President Trump to agree to the latest from Iran. Again, those are Iranian media remarks about the latest draft between Iran and Oman, saying that Iran is going to have an agreement on the Strait of Hormuz that will bar U.S. and Israeli ships from making their way through the waterway, but it will also have tolls or charges on countries that it deems hostile. A lot of traders are viewing that as a sign that it might be GCC countries and their tankers and vessels. Now, you're seeing the impact on oil prices. They're up today. You're seeing Brent about 1% higher, $83 on the barrel, so above that $80 mark yet again. So not a lot, but traders are still assessing what exactly this deal will entail. And you're also seeing that traders are reluctant to fully unwind long positions for the fear of being really wrong-footed, Lizzy, by a sudden escalation yet again in the Middle East. So we have that when it comes to the oil markets. We're seeing tankers and vessels either paralyzed in the Strait of Hormuz, trying to go through with their lights switched off. We're not seeing a lot of trickle of movement. We have heard from the UK Navy earlier saying that 2 ships have been attacked. Iranian state media also saying that it targeted 2 ships that it deemed hostile. So you're seeing the threat of getting ships and vessels hit in the Strait of Hormuz still very much prevalent in the waterway, which is why a lot of ship owners are reluctant to make their way through, despite those signs of a deal coming through over the next day or so. That is something we're still monitoring. We don't have the final terms of that agreement. And then parallel to all of this, the Red Sea, which Saudi Arabia particularly had resorted to in the past 6 months or so to get its oil exports through, is getting parallel aggression from the Yemen-based Houthis, of course, a militia that is backed by Iran. We know also that we had some casualties in Yemen itself with the Houthis targeting the government that is backed by Saudi Arabia, despite the fact that Saudi Arabia has been trying to speak to the Houthis via Oman over the past couple of days. That is what we reported through Bloomberg, according to our sources. So aggressions and the war really widening its perimeters all over the Middle East, Lizzy.
I'll pick up. Abir, thank you very much. Bloomberg's Abir Abu Omar. We'll see what the weekend brings when it comes to the developments in the Middle East. Before we get there, of course, we have a jobs report to deal with here in global markets coming from the United States. We're looking ahead to July's jobs report later today. Economists polled by Bloomberg expect hiring to accelerate to over 80,000 and the unemployment rate to hold steady to hold pretty steady. For more, let's bring in Bloomberg's Jill Desis, who has details of what to expect. Jill, I saw after the claims data dropped yesterday, Bloomberg Economics saying that the labour market remains stable. Are we expecting that kind of picture to come through in the jobs report today? What do you see?
Yeah, and I think, look, if you look at the broad consensus among economists, you mentioned looking at an uptick of 85,000 for payrolls here. That would be a pretty significant increase over June payrolls that came in lower than expected at 57,000. I will also point out Bloomberg Economics actually expecting a small uptick in the unemployment rate to 4.3%, although again, broad consensus is at 4.2%. So, looking at this data here, maybe you do see that pickup in hiring that does seem to be the strong consensus here. And then if you're the Fed, if you're sort of searching for reasons to raise interest rates, remember at the meeting last week, while it was a hold, you had 3 policy makers vote in favor of raising rates. Maybe that resilience in the labor markets, some broader resilience in the economy, some concerns about inflation, that's contributing to your calculus for potentially raising rates later this year.
And we've heard from various hawkish Fed speakers over the past couple of days, Jill. I wonder how you would factor in the geopolitics into that picture on top of the jobs data that we're waiting for later when it comes to the September meeting.
Yeah, Lizzy, obviously we're all keeping an eye on oil markets. You're seeing that uptick in Brent today up 1%. I think that, particularly when it comes to these ongoing concerns about the Strait of Hormuz, do we get a deal? Do we not get a deal? Are we actually seeing anything sort of freeing up there that does have to play into the calculus again for some of these Fed policymakers? I'll also point out the Financial Times had a report out this week saying that, Kevin Warsh is prepared to raise interest rates, to sort of try to build consensus there. If we're seeing hotter than expected inflation prints over the coming weeks. And so I think all of that has got to be weighing on the minds of these Fed policymakers as they look toward their next decision. Again, inflation obviously front and center. And so if you're seeing that uptick in oil prices sort of bring that pressure back again, I think, that's something that they're definitely thinking about.
OK, Jill, thanks for the preview. That's Bloomberg's Jill Desis. Those numbers coming at 1:30 p.m. London time. And a reminder that Kevin Hassett, the director of the White House National Economic Council, will be joining us on Open Interest at 3 p.m. London time.
Yeah, putting the Fed narrative and what the Fed does in response to the data. We're not supposed to think that way anymore, are we?
No.
That's what Kevin Warsh says. But I just did. That puts that front and centre, doesn't it? Interesting that we've got lots of reporting suggesting that President Trump, who enjoys calling a lot of people, has been enjoying calling Kevin Warsh as well to express his views on, well, who knows, but maybe monetary policy. We'll see if that influence lasts. But a lot of hawkish voices out of the Fed of late.
Yeah, I'm trying to remember all of the many over the past week. I know that there was Neil Kashkari,
Alberto
Daly,
Muslim, yeah.
Mary Daly, Lisa Cook.
Yeah, exactly.
Not everyone as hawkish as Kashkari, but, it looks like September might actually happen a hike.
Quite the roster. That is it for the opening trade. The Pulse is up next. They'll continue to take you through these markets and onwards to the weekend. Have a good weekend when we get there, everybody. This is Bloomberg.